Okay, everybody, welcome aboard. My name is Steve Lord. I'm going to be moderating today's event. So I'm going to just give you a little bit of background about why we're here, what we're going to cover today, and then I'm going to introduce our panelists. So I just want to confirm that everybody can see me. Yes, either text into this or somebody raise their hand or do something. Yep. All right, great. We've got a confirmation that you can see me. Great. Thank you very much. First of all, I want to mention, I hope everybody is holding up okay in the midst of all of this craziness. It's certainly a unique time. And as I say to a lot of folks at Elegren, this is probably my third or fourth once in a lifetime thing. So it's certainly the deepest and most, I think, challenging one that I've seen. So this is a super important time to keep one's head and understand where they are relative to both the challenges and the opportunities that this can present. So title of today's webinar is Navigating Today's Evolving Real Estate Market. And, you know, while this crisis still evolves every day and we're trying to understand what the answers are going to end up being, the idea behind the webinar was to present sort of an informed and engaging webinar to talk through how clients, whether you're a buyer, a seller, a renter, an investor, whatever engagement you might have with the real estate market in New York, how you can use the time to better educate yourself, prepare yourself, understand where we are now and where we may be going, how long ahead the road may be. Maybe it's not long, maybe it is long in terms of getting where you'd like to be. The panel that we put together today is a group of pretty seasoned industry experts. Each one of them are a leader in their fields. They've guided their organizations and their clients through previous crises, Hurricane Sandy, 2009 financial crisis, 9/11. I've learned working with lots of different companies that there are really two groups. There are the folks that were in business during one of those events, and then there are the folks that weren't. And in terms of imagination and being able to understand just how long and hard a road ahead might be, there's some real value in turning to experts and people who not only have the domain knowledge, but have had time in the trenches during a period when everything you thought you knew about a market is in question. Okay, so there's a lot of confusion around what's happening with the New York City real estate market, and one of the ideas here and in future webinars that we're going to be putting together is to collect these expert thoughts around various facets of it. Okay, the webinar today will be largely a Q&A. It's going to be pretty informal. These virtual formats lend to that anyway, but think of it as sort of a fireside chat that you would have attended at a larger conference, kind of a low-key informal discussion back and forth. I'm going to be adding some questions and some conversation starters, but generally the discussion will range pretty freely. I think the overlay to a lot of this too is it seems like it might be business as usual either now or relatively soon, but it isn't, and there's important distinctions to be doing. Last thing I'll say before we introduce the panelists, this is the first of a series of webinars we want to do. This is part one, so to speak. After this webinar, you'll be sent a survey to kind of get your opinions about what we talked about today, whether it was what you were looking for, what we'll cover next. There's going to be some questions around what you'd like to see in our next one. So please take the time to let us know your thoughts. We want to know what is important to cover for you. We're doing this for you, so please let us know your thinking there. And if there's stuff you would like, feedback you'd like to give, or ideas you'd like to share that aren't part of that survey, please reach out to your Elegren salesperson for any other communication ideas, thoughts, opinions, questions that come from this. Okay, turning to the panel quickly. As I mentioned before, we've selected everybody. These are folks that work with us at Elegren fairly closely. They're here because of their expertise in their field and the depth of knowledge they have about sort of where we are right now. As for me, just introducing myself, I've been a strategic advisor to Elegren for a couple of years now. I've got about 25 years now in middle market CFO and COO engagements, and started my career on Wall Street more in financial and macroeconomic research. I'm also pretty heavily involved in disaster relief, working with FEMA Region 2 as a liaison officer. So in the current environment, you can imagine it's been pretty busy. One last thing, if you are not on mute, please be on mute, okay? Thanks. Okay, so turning to our panelists quickly, we have Noah Rosenblatt aboard. He's the founder of Urban Digs. Urban Digs offers deep analytical data and highly customizable market stats to more than 1,200 agents and their customers in New York. Noah's going to be speaking today about data, questions about data, what trends are there. You know, we'll get into this later, but one of the interesting things about events like this is a lot of historical comparisons go out the window. We also have Scott Vandermark aboard. He's Senior Managing Director at First Republic Bank, which is a publicly traded leading private bank and wealth management company active across the country, but pretty active in New York City as well. Scott's expertise in financing, credit, liquidity, lending are all going to be very, very important for literally everybody on the call for the time being, or for the the road ahead I was talking about before. And then we also have Ross Levine aboard. He is co-managing partner for Schwartz Levine. Ross is founding partner of the law firm and its predecessor, Schwartz Levine and Kaplan, and he's co-managing partner in the firm's real estate department. Ross is here obviously as a lawyer to talk to us about closings, what the legal framework looks like, what's possible now under the New York on pause directive, excuse me, and things like that. Okay, so giving everybody a minute to kind of just digest everything I said, what we discussed earlier. I'll sort of query a little bit of conversation. We have a lot to cover. We may not get to all of it. That's fine. We're going to have more of these down the road. So we appreciate everybody being here. We're very happy that this is of interest to you, and we're looking forward to hopefully answering a lot of your questions. All right, make sure all my panelists have their videos on. Great, good to see you guys.
Good to see you.
So Noah, let's start right out of the gate with getting an understanding of what has the pandemic kind of done to the market from a purely inventory perspective. I mean, this is unprecedented, really.
Yeah, no, this is unprecedented, and there is no playbook for this scenario, and basically, everyone's on pause, and
Right.
everyone's trying to figure out where prices are and what's going on, and there is no price discovery right now. I mean, it's a dislocated market. It's a very thinly traded market. There's very little volume, and again, everyone's trying to figure out where it is, and it's quite difficult to really get a grasp of it, because at the end of the day, there's only been about 280 contracts signed since March 20th, and that no showings order. So the biggest story is not where the market is, because we don't know where the market is. There's no price discovery. Is it down 30? Is it down 20? Is it down 10? I mean, I'm sure it's case by case. The biggest story is inventory. And inventory, as your question is, it's constrained. It's way down at a time when it usually rises. We should be probably somewhere around 7,200, 7,300 listings right now for this time of year. We're closer to 5,000 right now. And the main forces behind that are, number one, there's far fewer listings being put on the market right now at a time when typically, again, this is when the listings come onto market. So what I mean by that is, if I look at March and I look at inventory that's typical for March over the last 3 years, there's about 1,800, just under 1,800 units come on the market in March. That's like typical. Well, this March we saw 924. And that was really a half of exposure that month. We didn't have a full exposure month. So April's really our first full exposure. So April, when I look at what's supposed to come on the market in April, we're supposed to get closer to just over 2,000 listings a month. And May is closer to 1,900, 1,950 a month. So there's far fewer coming on the market right now. If I take a look at how many listings came on the market so far in April, it's 196. So we're supposed to get 2,000.
Wow. So it's off.
And it's 196. Right.
Yeah. So the market's off. Do you get a sense that those folks are just saying, I'm just going to wait. I'm going to put my head down. I'm going to try to ride this out. Are the transaction prelude, the sort of thinking that a person would do prior to listing, is that just broken? What is your sense? And then does it bounce back quickly when the all clear sounds?
Right. So the assumption right now, of course we can't go into the minds of all the sellers out there. And if I look at supply right now, there's about 5,071. So, like what everyone is thinking there, it's case by case. Most sellers are just choosing to bide their time. Sellers that have not listed property, that were planning on listing property, I'm being told is just going to wait this out since there's no listing agreement signed. Whereas listings that have a listing agreement signed have taken their listings off the market. Okay. The only listings that we see right now is a combination of sellers that for whatever reason are comfortable listing property, or they're not in any rush to sell, or they are in a rush to sell and they're forced. So like it's more interesting to look at what types of deals are being signed right now, because if you think about it, we're supposed to see 1,000 deals and instead we're seeing around 280. So deal volume's down about 70%. And you think, what kind of deals, who's doing those deals? Like what sellers are hitting those bids that are down? We don't know how much they're down.
It's almost like the bond market in the 2009 crisis, right? Where there were no bids. It's like you couldn't
exactly.
sell if you tried.
That's exactly what this moment in time is similar to, is in the sense that it's dislocated, it's very thinly traded. And again, if there are trades happening, they're happening at discounts that we won't find out until about 4 to 6 months from now.
For a while. Yeah. Yeah. If it's any, looking back on it in the bond wreck, it came back fairly quickly, but it's a lot more of a liquid asset class, right? This doesn't have the lag, bonds anyway. So Scott, turning to the corollary of what Noah just said, are there changes in the underwriting? I'm sure there are, but if people are looking to purchase and finance to move in this market, what has underwriting done based on what Noah just said and where we are?
There are changes. I think the industry is still trying to figure out exactly how it wants to adapt to the current environment, and I think the adaptation is a little bit slow because I don't think anybody really has clarity on what post-COVID looks like economically for different industry segments, for the valuation of New York City real estate collateral. It's still a little bit opaque, but I think that there are a few things that are very clearly true. One, there's going to be a greater degree of thoughtfulness around industry segments. So if you're in the hospitality business, if you own a hotel, if you work for a hotel, if you own a restaurant, if you work for a restaurant, if you've got cash flow exposure to a segment of the economy that is particularly hard hit by the impact of COVID, then there is going to be an underwriting, a caring for that element in the underwriting of a deal. More scrutiny around the cash flow for people who have specific indirect exposure to the fallout of COVID. The same is true for liquidity. The current environment has created a lot of volatility in the financial markets, and so it is commonplace now to see dramatic fluctuations in asset values on equity portfolios, on bond portfolios. Everything is either down and or moving around a great deal, and so some folks that qualified for a deal comfortably 3 months ago are now not qualified at all, depending on how long the equity market they were and how unprepared they were for the collapse in value. And then the last piece that I think is impactful is that because no one really understands what valuation post-COVID looks like in the real estate market. Everyone is working with data sets that are retrospective, and the valuation industry, the valuation methodology, the appraisal industry is a retrospective exercise. It's not a prospective exercise, and so consequently, people are sort of guessing. And one thing is for sure, and appraisers are going to be more conservative, not less conservative, as they, whether it's subconsciously or consciously.
Oh, maybe we lost Scott right there.
There's going to be some sort of an inherent discount that manifests, and more equity. Yeah. So as a consequence of that uncertainty in in the valuation, of real estate, banks are going to require a little bit more equity than they have historically. So you're going to see an LTV compression.
LTVs go down. Right.
6 months ago, 90% was pretty commonplace up to $1 million in purchase price. You're going to see a contraction in 90% loan to value. You're going to even see a contraction, on 80% loan to value deals. When you get up to a certain price point for the super jumbo transactions, you can start to see more and more equity required by lenders into deals to manage against valuation risk, specifically related to the uncertainty of post-COVID valuation.
Okay, great. One quick question on that. So after the financial crisis, the banks were obviously at the epicenter of what really was a lending recession following the beginning of the recovery of the crisis. Because this is originating externally from the financial system in terms of leverage ratios and things like that, do you see banks being timid to lend for as long as they did? I mean, we're not at the end of this yet, but the financial crisis changed the way banks looked at origination of credit, right? Do you see that, or where they already were make it a little less of a shift?
So I think the cause is different. There is going to be liquidity stress on the financial services industry, which will then ripple through to liquidity in our marketplace, residential real estate in Manhattan. The cause is different in the sense that 2008, the banks got way over their skis and were had tremendous credit loss experience in the various lending portfolios of loans that they'd originated. The difference here is that but they had actually been the architect of those losses because they got reckless in their and lost their credit discipline. Yep. Here, the banks maintained their credit discipline more or less, to a greater extent or a lesser extent, depending on which financial institution you're talking about. But the landscape that they're lending into, the marketplaces that they're lending into, are in many cases in free fall, oil and gas, hospitality. And so
transport,
and general industry, even the sectors, transportation, airline. And everyone is drawing down on capital. Every emergency line of credit in the country is, I'm sure, drawn down, to its maximum extent. So there's a competition for capital, that is creating a squeeze on liquidity, and there's also going to be some loss experience that's not necessarily caused by poor lending discipline, as it was
imprudent lending, right?
But by the dislocation in the various industry sectors that banks lend into. So the result is relatively the same, and we're already starting to see, both in commercial and residential consumer markets, less liquidity, less capital availability. So
it's already starting to tighten up a little bit
than it was a few months ago. And there are going to be people that step into those gaps, and there will always be liquidity. We're doing that at First Republic, but it's going to be harder, not easier, as we move further into the COVID crisis.
More into a recovery zone. Okay, great. Right. Thanks. So moving then from there, Ross, are new contracts coming into your office? Based on what we just heard, are there changes? Can you actually close on deals right now? What's the status from your side?
I've had a handful of contracts come across my desk and we've negotiated. I will say that it's usually a factor where you have a buyer who's decisively entering into the market or who committed to that prior to the pandemic. And what he or she what they're doing is they're taking advantage of the pandemic in some way and getting the unit at a discounted rate. I've seen that more specifically in the new dev market, where the people have seen the product, or maybe they had the virtual tour at a sales gallery and they were thinking about jumping in, and now they can really jump in, even with some closing costs, concessions and things like that. So those have been the handful of deals that I've seen. It takes a motivated seller and it takes a decisive buyer. The biggest change I will see in terms of contracts themselves, and this has really been the way for the past few weeks, is negotiating what we like to call COVID-19 language, which really kind of protects a buyer for things that we never even contemplated or contemplated prior to the pandemic, but never really successfully negotiated. For instance, loss of job, loss of income, crazy delays that are not within their control. We have a handful of closings that are delayed because, the individual may be able to move in, physically, but not furniture. So how can you close? So there is that disconnect there too. So we have a lot of things on hold in terms of closings. But I will tell you, people are trying to get closings done when you have, again, two motivated parties. They can be done virtually. It takes a lot more effort, but you need someone who has experience in doing it. You usually enlist the help of a title company to continue its due diligence and its searches, to maybe collect documents. It requires potential utilization of the new notarization law that they adopted, that we can do virtual notaries, coupled with potentially a title closer who's willing to meet with the buyer at their home. I've done a few of those. So there are mechanisms to get deals closed. Wire transfers are typically the norm as well. No checks are being cut and handed across tables like we usually do. Constantly, I will say on a daily basis, I have my buyer clients trying to ask me, can I get out of my deal or can I renegotiate my deal? And I will tell you, probably 99.9% of contracts do not have what everyone's reading on Google force majeure clauses. All right.
Force majeure.
There are no force majeure clauses that protect a buyer. Again, I don't want to say none, but 99.9%. So with that said, a buyer who is in contract really needs to figure out if they want to burn goodwill with the seller and potentially delay closing and, be sued for default. Now, on the other hand, a seller could be weighing, well, shoot, I may take their deposit as my best remedy in the contract, go to court, be held up who knows how long,
years,
and then relist my apartment at a lower price. So quite frankly, most of my buyer clients have not been successful in renegotiating deals. There have been one or two, again, if a seller is extremely motivated. It has to be a good negotiation discussing either potential coverage of common charges in the future, or maybe a price negotiation just for timing and delays. But I laugh. I mean, I don't laugh because this is all terrible, but there's a part of me anecdotally that I remember when it was a seller's market, and I used to tell my clients, how often do you have sellers and sponsors coming back and saying, you know what, it's a seller's market. Let's increase the purchase price. So, to that end, yes, this is clearly something we all haven't dealt with, but there's no guarantee that a renegotiation will be successful. But you have every right to do so.
Okay. So just for everybody aboard, we have a Q&A button here. We are getting some questions in there. Because we only have a limited amount of time, I will try to get to the ones that I think are in the middle of what we're talking about. But if we don't get to the questions that people submit, we'll try to get you an answer one way or the other between now or when we do future webinars. We may build these questions in. One of the questions that's in there that's relevant to what we were just talking about is, I guess for all of you guys, why are sellers selling now? But very quickly, I don't know if that's for you or for Scott, but what is the catalyst that's causing a seller? Is it a cash crunch? Are they in the middle of a divorce? Are there a couple key things you're seeing that are forcing hands?
So unfortunately, the data that I get does not have any kind of categories in terms of describing why the seller's selling. We could, I think, safely make a few assumptions. I think the sellers that are selling right now, and again, I mentioned those 286 deals since March 20th. A lot of those deals were residual deals, like Ross was mentioning. Okay, that's 100%.
So they were already in the pipeline. They were.
Yes.
Right.
And in fact, in the last 7 days, we've only had around 42 deals, I think, signed. and we were at 290 or so since March 20th. So the majority of that deals was in the front part of March, and those were deals that were in play, for lack of a better word, when this Corona crisis hit.
Right.
Now, again, so that's not a lot of deals. If you look in the last couple of weeks, it's like 90 deals in the last 2 weeks, when that should be more like 500-600, right? So who are those people, and why are they doing this? I mean, I guess you can make a couple of assumptions. Number one, there are sellers that for whatever reason are forced to liquidate, whether it's a margin call, or it's another financial event. They lost their job, or some other event related to financials where they're just forced to hit the bid. And in times like that, you can only hope that the market's functioning and that we actually have a offer that's somewhat deemed acceptable that they could hit. Those are going to be the bottoms of this market.
Yeah,
those are
a functioning market. Yeah.
Yeah, that's the dislocation, and those are gonna define the bottom. That's gonna be like your Lehman trades, for lack of a better word. And there's not gonna be a lot of them. There'll be just a couple of hundred.
I think the margin call element is probably larger than we realize. Right.
The margin call element, you got the fear element. You got sellers that just don't want into the market. They may not have a margin call, but they just have fear. They just want out. And then you got those sellers that have a property from 20, 30 years ago. They bought it in the 80s. They have it for $500,000, or if it's an estate and it passed down. And again, look, they're sitting on $2 million, $2.5 million of equity. You know, I'm using a hypothetical here, but you could parlay this into any sector of the market. And look, that it was worth 2.5 million before Corona, and the bid right now is 2.122, and they're hitting it. And like, you know what? I'll hit the bid.
I'll take it. Yeah.
If I can jump in,
segment, which is that if you are selling at a distressed price, and you're going to convert that sale into a purchase, you're also buying in at a distressed price, and you know there are sellers that are executing both trades simultaneously that feel a little bit better about selling on the into a distressed market, because they're simultaneously buying into a distressed market, and what they lose on the sale they'll make up on the buy. And that actually is, you know, that should be an opportunity for the agency marketplace to capitalize on that mentality. You know, just because you're selling at a distressed price doesn't mean that there is an opportunity to capitalize on the same dynamic. You know, when you buy back in. Yeah.
And Scott, just to follow on that, no, I know you or Ross, you have a thing to add just really briefly. Do you obviously those folks that are doing a pair trade like that are working with lenders? Are there things that sort of flag when the person backstopping the buy trade may flake out, may back out? Are lenders reticent to make that sort of swap from your perspective?
No, I mean, I don't think there's anything about a buy and sell, you know, that raises any particular red flags. I mean, I think that the only thing that I think is probably worth mentioning in that regard is historically, you know, the New York City marketplace is so liquid, has forever been liquid. Will, you know, with the exception of pockets like, you know, 2008, 9/11, today, you know, continue to be liquid in my estimation. Lenders have tended to allow buyers to acquire property pending the sale of their departure residence. So you know, the industry has gotten comfortable with qualifying buyers, you know, on a bridge basis, without the completion of the departure residence sale, assuming that property will sell, because everything that gets listed in Manhattan will eventually sell. And I think that those sorts of bridge transactions will be scrutinized a little bit more carefully, and will be a little bit more difficult to accomplish, because you can't necessarily, you know, at this moment in time, assume that the market is as liquid as it has been historically. Right. So it might take longer to clear the trade, you know, of the departure residence, and it certainly might actually require a lower amount of proceeds that you get out of that transaction. So you'd have to really think carefully about, you know, sort of discounting, you know, the price at which you're offering the marketplace as you sensitize, you know, the purchase and what
for the other side
you're going to get out of the sale for the purpose of acquiring the new property. Other than that, you know, no red flags.
Should be straightforward. Good.
Good.
Right. Ross, I had stepped on you before. What
Yeah,
did you want to add?
yeah, no worries. I mean, the way I kind of envision all this is that in the beginning of the pandemic, we all were trying to, our community really has never dealt with something, with virtual closings and trading documents and using couriers and holding on to wire transfers as much. So I would like to think that we dealt with the worst. And if we come to May 15th, God willing, and the lockdown is lifted and agents can show properties, I do think there'll be an uptick in numbers of not necessarily contracts, but definitely listings, right? There may be a handful of people who want to exit the city. And contrary to that, there are people just like after 9/11, I hate to say, buyers with decent capitalization took advantage of low prices and built up their, and took advantage of inventory.
Right. Well, that's how it works, right? Like you have a dislocation like this, you're going to have deflating prices because of a lack of demand, and then people who are liquid will be able to come in and take advantage of it. It sounds awful in the context we're in, but it's market. It's how markets work. Proceeding from there a little bit, right? So we're now in this position, and this is for everybody. We're in this position where there aren't really going to be good comparables. We have a little bit of a seized market after 9/11. We had a deflated market after 2008, 2009, but it didn't really seize I don't think in real estate as much as it did in other financial instruments. But, as Ross, you were saying, as we start getting more contracts, say over the next 2 or 3 months, we're going to start seeing data that is informed by or germinated out of the crisis era. And so to what Noah was saying earlier when we began, what should everybody on the call be looking for in that early cohort of sort of COVID related data points as the market starts to unlock? I mean, what can they learn from there? What data is going to be important to look at? Obviously price is there, how much have prices moved, but I feel like that's simplistic. There's probably other data points that are going to be worthwhile. I don't know, Noah, if you want to take a pass at it, or Ross, since we have your picture up.
Well, prices are illiquid and highly illiquid. Oh, I'm sorry.
No, go ahead, please, go ahead.
Again, if you're looking for prices, it's extremely illiquid right now. I mean, we don't know what the deals are, the 280 deals that are signed in the last 4 weeks. And we're not going to know that unless you start making phone calls and calling these guys up and getting access to some comparable deals that 1 or 2 deals that are in your sector, and finding out how low they are. You could get those anecdotal requests. You're not going to get that from the government until August, September, October.
Right.
Okay.
And there's not like there's a tape that prints, right? You're not.
No. Well, so there is no. So well, in sales, it prints, but again, it's at a lag. So like if something closes today, right? And those deals that we're talking about, those are contract signed. Those are going to take 3 months, 4 months, 5 months to close, right? So if something closes today, it's going to take the city another 3 weeks, 2 weeks, 3 weeks to file that sale, maybe longer. So there is a lag there to get that data.
Yeah, that's when the city's working, right? I mean, if the city's, so it could be 3 months.
But on a real-time basis, what you want to look for is we do have access to listing data. So, and that's the only thing we got. So like we don't have much, right? But I do have inventory data, I do have off-market data, and I do have contract signed transactional volume data. Mm-hmm. And so what you're looking for, and if you look at what's been going on over the last 4 weeks, we have a lot, inventory is way down, contract signs are way down, and off-market is way up. So you have those 3 things. So what you're looking for is you're looking for active inventory on a week-to-week basis to come up. You're looking for contract signed to come up, and you're looking for off-market to go down. And off-market actually is starting to go down, but the other 2 are not reversing yet. So I'm seeing one of the 3 trains start to, indicate, like you're saying, that we're maybe bottoming out of this process. But I will just say one thing really quick. I do think that we're in this dislocated period, which is going to last many months, okay? And we're already 6 weeks into it. So we're in the middle of it right now. We're not in the beginning, we're not at the end, we're in the middle, right? And within this period, there's going to be different windows of acute, severe dislocation. And to give you an example of that, I think we've already had one. I think March 15th, March 17th, March 18th, that whole week in March, mid-March, ending of March, right? That was much higher level of fear. than there is right now. When you look at the stock market and you look at the numbers and you look at the hospitals didn't have the equipment, we're in a little better place right now than we were. So I don't think deals being signed today where the contract is executed by a guy like Ross in 2 weeks from today in May, I don't think that dislocation is nearly as severe as the dislocation 3-4 weeks ago.
3-4 weeks ago, right? Well, that's one of the first rules of crisis management is, right, the shock is the first thing you have to get over. People are very adaptable. You know, there's a well, I won't bore everybody with the theory, but there's reasons for that. That's another webinar down the road. One of the things that I think is important, there's a couple elements to remind everybody about on the call. One is, you know, there was a different leverage position in 2008 and 9 that hamstrung an awful lot of people from coming into the market to take advantage of those dislocations, which I think is going to be a little bit better now. People aren't nearly as geared, and the financial system is not nearly as set up to sort of undercut the momentum or the velocity inside that credit creation. And then the other thing to point out, since this is an Elegant webinar, is this information that we're talking about getting, this data, these off-market deals, the beginnings of the green shoots of a recovery will be seen first probably by the folks in the real estate business, agents, lawyers, right? There's going to be data folks like, no, there are resources there to be able to have a closer ear to the ground as the data becomes apparent, right? So instead of necessarily waiting for New York City to print the tape, so to speak, you know, pick up the phone, reach out, send an email to your agent. Maybe they have data or information around what you're looking for, okay? So before I leave that topic, anything else anybody wants to add?
Well, I just want to jump in real fast, though. I do think that's an important part, to have an expert, like, let's say, an agent or an agent in general, to essentially look at listings, like what Noah was saying, because I personally think recorded contract sales price, or really just purchase price, if you get it from Acris, it may not necessarily give you the exact details, right? For instance, we all know with new developments, there are built-in concessions, even though the developer may have nailed down the price that arguably was the original pricing. Right.
So you don't see it, right? Correct. You don't see what the real.
So I think, you know, new development may be a little hard to judge, but someone like Noah or an Elegant agent could easily sift through some of that, you know, the clouds, if you will, and kind of get to what exactly is out there. Because, you know, it's impossible to rely upon the data of the closing. Yeah.
I want to just give a brief segue to that, when this is going back years and years ago, but in various crises back in the equity market days, when the world was shifting toward online brokerage, when the tech wreck happened in 01 and probably 9/11 as well, the value of the broker became apparent to an awful lot of people that had gone on to firms like E-Trade and Daytech, and they were all pretty new, and everybody's like, oh, I don't need a stockbroker. But you know what, when the you know what hit the fan, all of a sudden they found out that they really needed to have a person on the other end of the phone line who had experience and domain knowledge about what they were asking. It's not as easy as just clicking buttons when there's something as big as a dislocation like we're in right now. Yeah, good stuff. So, I mean, this all ties into sort of like the broader environment, but in all, and this is an open question, so it's a jump ball, whoever wants to get it, but in your guys' experience, having been through prior dislocations, do you think the little bit of price information we do have is indicative of the kind of decline we may have, or is there additional legs down as liquidity returns? And follow-up to that is, will sentiment track the data, or will the data track the sentiment? Jump ball.
I guess no one's rushing for this one, Steve.
Well, that's my job, right?
I mean, I think for sentiment, I think here's the problem. I think everyone's going to come back at their own level. I think a lot of people, in terms of buyers out there, are waiting to see some level of transactional rebound in the markets. They're waiting to see contracts be signed. They're waiting to see active inventory come. They're waiting to see the market act more like normal. I think it's very scary for a lot of buyers to put bids in, but at the same time, the buyers they dream of scenarios like this. They talk about it all the time. And let's be real. I mean, they were bidding in a market in Manhattan that was already down for 5 years. Like, it's not like Manhattan had a peak when this happened. We were, 2015 was a peak, and we've been coming down for 5 years, not crushed at all by any means. The broader market really was down maybe 15% over the 5 years, like a slow drip kind of thing. But we were coming out of it. We were actually getting stronger, and we're coming out of it. And then this hit. So I think it's an amazing buying opportunity. I really, really do. And I think, quite frankly, I think the lowest part of it is already beyond us. I think those people that signed contracts, signed contracts in early April, and because they had an offer accepted in mid-March or late March, I think they probably nailed the bottom at this point. And there's still good deals and dislocations going on, and there will be for another couple of months. But I just don't know. Here's the thing. There's not a lot of inventory. So that's one thing. And how much of that inventory, how many sellers have to hit that bid? Like, I mean, honestly, how many sellers are forced to hit that? So you got buyers down here saying the sellers are wrong. I'm bidding down 20, 25%. That's what it is. And the sellers are saying, no, you don't get it. I don't have to hit that bid. I can buy my time. And there's just less volume. And that's what's going on.
And I think it'll shake itself out over the next 3 or 4 or 5 weeks. One thing I'll also say from prior crises is the vast majority of people miss when it ends. We tend to cling on the last sentiment we had, and the ground will start to shift the other way before we're all really willing to acknowledge it, before the media is talking about it, before it's visible and apparent. That's the old saying, right? If you're hearing about it in a taxi, it's too late. So for everybody on the call, if this holds to market psychology that I think I've seen in every market I've ever been involved in, you will not, it's not like they're going to fly a banner over the city saying the crisis is over. You'll start seeing inventory trickle back in. You'll start seeing transactions happen. To some of the questions in the Q&A, there's not enough deals, I don't think, to really show what the price decline is going to be. You'll know as the volume is starting to come back in. But as I think Ross pointed out, you're not going to necessarily feel it anyway, because it's going to be masked a little bit from you, at least in the published statistics, right? And
Steve, think about the co-op boards. Sorry, I don't mean to interrupt. Think about the co-op boards that may or may not allow any of those deals to go through.
Right. That's another whole element to this, right? What about new build? What do you guys think this does to new build prices? What is it? Does the inventory unlock begin there, end there? Like, what about new construction?
I think new construction was already had too much inventory to begin with, at an artificially inflated purchase price. That's my opinion. And I think it will come down. I think it will continue to come down. I don't think it'll come down significantly. I saw more of a drop in terms of pricing and pricing concessions over the past 2 years. I personally liken all this almost more closely to 9/11. Because I tend to believe people who are committed psychologically in exiting the city, if this is the reason that pushes them out, then so be it. There are still going to be a tremendous number of people who still hold on to the city and want to live there and believe in its value and culture and all that jazz. And I think that's going to attract the buyers to come back. I mean, how many people after 9/11 had no desire to live in Tribeca? What's the most expensive location in New York City? Yep. So, with that said, I'm seeing some clients get price negotiations, but most not. But I've seen a range from anywhere from, let's just say, 3 to 10%. And honestly, it's not many people, because a lot of sellers have already accepted a buyer's market and gave a decent price to begin with. So I'm not, they're just taking their chances.
Mm-hmm. Okay. Well, you brought up an interesting point, right? Because if what you said is accurate, then everybody who's going to leave New York because they don't want to do this quarantine thing again, that will, if there is a little bit of a depression in prices, and there are buyers that were looking at New York going, you know what, I'm going to wait till I can get in, that the water tends to rush into New York whenever there is a little bit of a price drop, a decline. It doesn't last very long, and then there's usually enough people out there to fill in the hole. What about overseas buyers? We've got a couple questions in the Q&A. This is not only from a transactional level. Do you think the foreign buyers start coming back in, but also from a lending level? Do you, I guess that'd be for Scott, do you think there is an appetite to lend to those buyers if they're, presenting on paper liquid enough?
I think that if you think about the continuum of credit risk, with foreign nationals being on the far end of that continuum, I think that there's going to be, there has always been less liquidity for foreign nationals than any other buyer segment in the city. And I think that there will be even less liquidity moving through, COVID for someone from another country that doesn't have, visa status, doesn't report income in the US, and doesn't have any liquidity, that they can demonstrate in the US. I think those buyers are going to be increasingly difficult to finance. They will be financeable on some level. We're still financing foreign nationals so long as I can get transparency to cash flow and liquidity and some sort of reasonable visa status. But I think that buyer segment becomes harder to finance.
But it might be getting them to show back up as opposed to changing anything about how they're financed. Got it.
I want to just go back to new development before we completely depart that segment of the conversation, because I think that's a very interesting part of the New York City real estate story. I don't think that story is told yet. I think that the new development space is probably the segment of the marketplace that has gotten least honest on valuation than any other segment, and the spread between Schedule A's and the small discount that developers have been agreeing to and the reality of the marketplace is as wide as it's ever been.
Right.
Part of that is because some developers maintain a hope springs eternal mentality. Some developers are not actually able to reduce their prices because their construction loan agreement doesn't allow, their release price schedule doesn't allow for a further reduction in price. And
that's where the concessions are coming from then, right?
That's right.
Partially, yeah.
And so what all of that means is at some point, I think there's going to be a reckoning. We're starting to see that reckoning selectively throughout the city on certain new development sites where, there is a quiet recapitalization of those new development projects. New money is coming in and cramming down the equity and forcing down prices. And so I think you're going to start to see over the next 6 to 12 months or so, certain new development projects with 15 to 20% discount off the original Schedule A.
Oh, okay.
Because those projects have become recapitalized. There's a new group that's making decisions that has a different set of economics that is governing their decision making, and they're now able to allow for lower prices to clear the inventory out. And the only thing they care about is clearing the inventory.
Getting the inventory out. And they will have come in after the crisis. So they'll have been informed by where we are now as opposed to 5 years ago, right?
That's right. So I think you're going to see some selective, special situations that are represent really cool opportunities in the new development space. Okay. One caveat to that is new development is probably a little bit harder for buyers to get their head around than ever before, because any new development that has a timing gap between contract execution and funding, exacerbates the risk that is already perceived around COVID, because, now you can't close in 30, 60 days. You might have to close in 180 days, and everybody's, financial existence is so tenuous right now. You want to take a 180-day gap risk that you're going to keep your job, your income is going to stay the same, your investment portfolio is going to be maintained. So, new development, increasingly difficult to, risk profile to think about.
I just want to jump in real fast, Steve, to get back to your original question. I've done a lot of deals for overseas buyers. I've been to Asia many times over my career. I believe, similarly to the 2008 crisis, cash is king. People who have cash, especially foreign nationals coming over, will absolutely take advantage of this market. I'm not saying it's going to be a crazy influx in the beginning, but I do believe within maybe 3 to 9 months, when the dust settles, there'll be, I think the foreign market can easily take advantage of the local market. Secondly, there's no reason not to, because rentals are still strong. I think there's someone from Elegant today that posted data that rentals are remaining consistent. So, with that data point, there's no reason not to invest if you're a foreign national, especially with the volatility in the stock market.
Steve, you seem to be on mute.
Yeah, Steve, we can't hear you.
We can, the panelists can hear each other, but Steve, you seem to be inaudible.
I guess my point was so good.
Uh-oh.
Steve's coins ran out.
It doesn't look like he's on mute, though.
He's not.
Yeah. Are we on our own? Are we going to have to end this thing? There's a lot of questions in this Q&A here. All right. Someone's saying they would jump in. I mean, I don't know what to say. 2008, this guy's questions is 2008, 2009 was quite different, though. It only impacted banking and mortgage. People could still go out and spend money. This is completely unprecedented. And people can't get out. I mean, yeah. I mean, there's nothing to disagree with on that. I mean, that was isolated to the mortgage-backed securities markets and the financial industry and the Wall Street, and this is everything, and we're completely shut down. So there's no playbook for this, but there's also no playbook for $6+ trillion in stimulus. That's probably going to go to 10 plus or 15 plus trillion by the time this is over. So it's like deflation versus all the inflationary stimulus they're trying to put in to reflate us. So we'll see what happens when that solves down. I don't know, Ross, Scott, you got any thoughts on that?
I think I think that this is a little bit different than 2008. I think that it's going to be, as difficult for different reasons, but I think that the buying opportunity, that manifested out of 2008 is going to be replicated here. I've been bullish on buying New York City real estate over the last couple of years as the housing recession has continued. I mean, we've been a luxury New York City housing recession for 3 years. As values have continued to tick down, and I've been bullish all the way down. And I think that the environment has been waiting for this moment. I think buyers, I think the marketplace has been, waiting for the last shoe to drop, which I think it's unfortunate that it had to be COVID, but I think that the recessionary environment that's being ushered in here is what a lot of people have been waiting for in order to get to the other side. And I think that it means we're getting closer to the bottom. I don't know what the bottom will be. I don't know how much further we have to go, but I remain incredibly bullish that there is going to be another side to this with all the stimulus. There's going to be an inflationary environment that's on the other side of this that's going to make real estate asset class, a great asset class to own. And people will be rewarded handsomely for having invested, in New York City luxury real estate over the last couple of years, and particularly in the current environment.
Hi guys, I am back. Can you all hear me now? Sorry about that.
Hey, welcome back.
Yeah, my computer flaked out, so the challenges of Zooming all the time. Sorry about that.
Steve, I was just doing a couple of Q&A while you were.
Okay, great, cool. That's where we were headed anyway. So we can do. We've got a few minutes left. I'm conscious of our time. I don't want to go too long, but if you guys were in the middle one, let's wrap that up, and then we can.
Oh, we're done.
Okay, great. Okay, cool. So again, I apologize for blinking out. We did have some macroeconomic stuff we were going to get into. It's a little bit more meaty and a little bit probably longer form. So I think we might move that to the next webinar since we're close on time. Like I said at the beginning, we are going to have part 2 of this. So part 2 is going to have things like what are the differences between 9/11, 2008, now macroeconomically, what about interest rates? What about inflation and deflation? I have a lot of thoughts on that, so we'll save that for the next one. Just a quick hint there. I don't expect there's going to be this huge surge of inflation, and we can go over why. We are in a hugely deflationary moment right now, and that's going to push out any inflation that all this spending is going to cause. But anyway, don't want to give that too much away. We also, I think we'll cover in the next one a little bit more granularity around pricing, co-ops, not co-ops, things like that. I do want to remind everybody, we're going to send a poll around. Please do the poll. It's very important that we get a sense of how you thought about this one and what we're going to cover in the next one. And we, again, we can't thank our panelists enough. Guys, thanks for coming aboard. We are very grateful that we have your value and your experience and your insight and thoughtful answers to the questions today. Oh, wait, I'm getting texted that we are sending the poll right now, actually. So never mind the emailing that I just said. Here's the poll. Please take a moment, fill it out. It's very straightforward. It's like a 2-minute poll. And again, guys, thank you all very much for coming. Thanks again to our panelists. Thanks to Elegant for putting this together. And for everybody on the call, stay safe. Keep the social distancing and all that stuff. Not much longer, but if we hold this all a little bit longer, our city will come out of it strongest. All right. Thank you all very much for coming, and we look forward to seeing you on the next webinar.
Thanks, everyone. Bye-bye.
Bye.
Bye, guys.